Hello and welcome to the June 2026 market update for Maria, Mid-Atlantic Real Estate Investors Association. I'm Alan Shanker, the president and co-founder, and let's get started. So one of my favorite quotes, history doesn't repeat, but it rhymes. But I do believe in business cycles and keep your eye on that. Express success is very important if you're starting out or even if you are just relatively new to investing in real estate. Nina Jones Cox, who is a great businesswoman and real estate expert, can show you how to make your business run more profitably. And this is a once-a-month coaching call plus some times when Nina can answer your questions. She can help you through any difficulties you may have with a deal. So this is a great benefit if you are a new or a relatively new investor. And you can get this on the Maria website. It's $12.97 for a year's worth of what you get. You get 12 months of coaching and online help, as well as you get all of the Saturday workshop that we have. There's 2 a month, so that's except for the holidays in the fall and winter. In which case, there's about 20 a year at $47 a piece or higher. You get your money back just by attending all of the workshops, or you get the recordings. If you're not able to attend in person, you get the recordings. You have your own library of detailed information from experts around the country. If you're interested in this, go to the Maria website, or you can email hello@Maria for more information. Okay, the stock market, which does affect the economy, which indirectly affects the housing market, is fear. This is for June. This is a few days ago. We're into June, but the fear index was 35. So people are afraid the stock market is going to go down. But again, this is only indirectly affects the housing market. If the stock market were to crash, housing prices would come down as well because people would be fearful of spending any money committing to long-term spending on a mortgage. Mortgage rates over the last 75 or 80 years has been around plus or minus 7%. I apologize. Looks like I made a mistake here. I think it was 6.32 last month. I forgot to take out the 5. In any case, it's up a little bit from 6.32 to 6.36. Not a huge amount, but nonetheless, you can see the history going back to the 1970s, where interest rates were as high as 18+% down to 2.65 during the pandemic. But you got to remember that the 6% is not too high. It's only high compared to 2% where we were a few years ago. But again, you can't get too wrapped up in mortgage rates unless they go way high to 18%, which I don't think we're going to see again in our lifetimes. So Baltimore metro area, the monthly supply is 2.4, as you can see here. It's about 50% higher than the average 5-year average. Monthly supply means how long it would take to sell all the houses that are listed for sale at the current rate that they're selling off the MLS, strictly from the MLS and not off-market deals. In any case, the days on market is going up. I'm sorry, the months of supply is going up. And when the basic wisdom is 6 months of supply is a balanced market between buyers and sellers. Less than 6 months is a seller's market. Sellers have the upper hand. And more than 6 months, buyers like us have the upper hand. Right now, it's still a seller's market, but it is increasing. I think we'll see that increasing as the months go by. This is the Baltimore metro area year over year. So May over May 2025 over May 2026, you can see that almost all of in fact, except for Carroll County, all of the jurisdictions went up by a nice percentage. Baltimore City had the lowest increase, 2%, but nonetheless, Howard County, where the schools are rated top in the country, that went up the most, and you can see why, because people want their kids to go to the best schools, they're willing to pay for it. So overall, the Baltimore metro area is doing pretty well for the housing market. This is Baltimore Metro. This is the city plus the jurisdiction surrounding Baltimore City. You see the trend here, days on market is going up, which again benefits us as investors because we want the days on the market to go up because as sellers get more anxious, they're going to lower the price. It'll be more open to negotiation. Again, these are MLS data, days on market, DOM. You see the trend here is up, up, up. Now the peaks here are the winter selling season, when it takes longer anyway, but winter of 2023, You can see it was about 20, excuse me, maybe 19 days. Then it went up to 22 days, and now it's up to 30 days. So the trend is favoring us investors to get lower prices and having more motivated sellers. DC Metro, its story is pretty much the same. We're very similar, even though the prices are a lot different. The days on market's going up by 50%. 5-year average is 1.8. Certainly, May of 2026 is 2.7. So again, the month supply is going up in our favor towards the buyers. Still a seller's market, but it's going up in our favor. Okay, you can see the prices are considerably higher for the DC market. I'm going to look at the Maryland suburbs. Montgomery County, Frederick, Prince George's County are considered Maryland suburbs of DC. DC itself went up by 4.2%, but look at Falls Church took almost a third drop from 1.75 million to 1.2. That's a huge drop because again, that market is very sensitive so you can see that may be a bellwether of coming attractions for prices going down, maybe not by 30%, but prices overall went up for most of the DC market except for Alexandria, which went down a little bit. I'm not sure. I don't know the DC market that well as far as to tell you why that happened. But Prince George's County went down a little bit. May have just gotten too much for that particular market, but only by $4,000, which is not a lot. Not even a tenth of 1%, or not even 1%. It went down very little. But Montgomery County is still very desirable, 6.5% up. And for the most of the DC market went up year over year. That's May of 2026 compared to May of 2025. Days on market, again, the trend is the same, maybe not quite as dramatic, although here it does take a huge. The winter market went from 20 days to about 21 or 22 days to like 36 days, 35 days. That's quite a jump from 2024 to 2025. Now, again, this peak is the winter selling season when not as many houses are being sold anyway. Nonetheless, I think the trend is up. The days on market's going to go up and up. And if you're doing the DC or Baltimore market, be aware of that. If you're a flipper or a rehabber, you have to account for longer holding costs because it's going to take longer to sell your house on average. Okay, takeaways, the bottom line is the same pretty much every month. We're not seeing any huge changes year over year. There's not going to be a crash that I can see in the DMV, in the district, the district, Maryland or Virginia. I don't see that. We can have a shortage of housing, and as long as there's a shortage of some type, the prices are going to stay pretty steady. So you can raise rents, but you got to be careful. Don't raise your rents that faster than wages. So again, the bottom line, flipping will still be very profitable, but again, you got to be careful. Your holding times are going up, so you have to account for that when you make your offers. Rentals are almost always safer bet for the long term if you're going to buy and hold, which is the best way to long-term wealth in the real estate market. It's unlikely that we're going to have a crash anytime soon, or even a glut for the next 20 years or so. So baby boomers are retiring, and they're dying off. The baby boomers born 46 to 64 are turning 80 this year. Every year, they're going to get older and older, and they're going to be dying off or moving out of their houses to maybe retirement communities or shared housing like residential assisted living that we're going to have a speaker on July 9th in our main meeting to talk about this and why this is profitable for the next 20 to 40 years. So rentals are always a safer bet for the long term, but residential assisted living is probably good in the next 20 years to make money. It's kind of a rental play, but we're having a speaker from the Residential Assisted Living Academy on July 9th to talk more in detail about that. And finally, there is no national housing market. When you hear people talk about the housing market on national TV, any of the broadcast networks, CNN, ABC, CBS, NBC, things like that, those numbers are not really important to us. We have to look at the local market, which is what I give you every month and what I deal with every month to show you the numbers that are relevant in our market. So mortgage or rent payments cannot outpace growth in wages. So wages go up slowly, but you can't ask your tenants or your home buyers to pay more. If their wages are going down, they're not going to be able to afford higher rents or higher mortgage rates. So keep that in mind. I think that wraps up us for the month, which it does. Again, let me remind you that July 9th, we have Residential Assisted Living Academy. speaking at Maria's meeting on July 9th at the Holiday Inn on Jessup, Maryland, on Washington Boulevard. If you're looking to make money by buying and holding with shared housing, this is a form of shared housing, which is much more lucrative, even than regular shared housing where you're renting rooms. This is much more lucrative because you actually have people, baby boomers tend to have more money as a part of the society than any other segment of the US. So baby boomers have the money to spend and they're willing to spend it to make their last years comfortable. And Residential Assisted Living Academy is going to show you how you can profit from that on July 9th. If you're interested in Express Success or signing up for the July 9th meeting, go to the Maria website. And otherwise, we'll see you on July 9th.